What if I told you that the most powerful trading system ever created didn't come from Wall Street, a fancy hedge fund, or some genius math PhD? What if I told you that it was taught to a random group of people? A blackjack player, a Dungeons and Dragons game designer, a security guard, and turned them into millionaires? And what if the only reason most traders fail to replicate it isn't because it's too complex, but because they simply can't follow it? This is the story and the exact blueprint of Richard Dennis's turtle trading strategy. The system that turned $1,600 into $200 million and proved that trading success is not about being born a genius. It's about following a system with unwavering discipline. Are great traders born or made? In the early 1980s, Chicago was buzzing with trading legends. And among them was Richard Dennis, a young man who had already made millions by trading commodity futures. Known as the Prince of the Pit, Dennis believed deeply that anyone could become a successful trader if they just had the right rules and the discipline to follow them. His partner, William Eckhart, didn't agree. Eckhart argued that trading success was innate, that it required a rare, almost mystical psychological makeup that couldn't simply be taught. Dennis, ever the experimental thinker, decided to prove him wrong. He placed an ad in major newspapers, inviting applicants with no trading experience to come learn under him. He called them his turtles, inspired by turtle farms he had visited in Singapore, where turtles were grown systematically and predictably. More than 1,000 people applied. Only a handful were chosen. And these weren't finance prodigies. They included a blackjack player, a software designer, an Air Force pilot, and even a security guard. Their only shared trait? A willingness to follow instructions. They would become part of one of the most famous trading experiments in history. 2 weeks to change everything. The turtles received just 2 weeks of training. Imagine that, in just 14 days, these novices were handed the exact system Dennis used to make millions. They learned how to read price movements, how to calculate volatility, how to size positions, and most importantly, how to remove emotion from every decision. Dennis believed that psychology was the true battlefield of trading. He knew that anyone could be taught entries and exits, but few could stomach sitting through a losing streak or watch a winning trade retrace without panicking. The turtles were drilled in mindset first. They were taught to expect losses and embrace them as the cost of doing business. They learned to see each trade as one of hundreds, each an independent outcome in a giant probabilistic game. This mindset shift alone was revolutionary. Instead of seeing losses as failures, they saw them as necessary steps in a long-term edge. Trend following. At its heart, the turtle system was simple. The trend is your friend. Dennis and Eckhart taught the turtles to stop predicting. No crystal balls, no wild guesses, no fundamental analysis of global grain harvests or oil inventories. Instead, they waited for breakouts. They learned that big money is made not by being right, but by riding the wave once the market reveals its direction. The principle was elegant. Buy when the market breaks above recent highs. Sell when it breaks below recent lows. Nothing else mattered. Not earnings reports, not CNBC headlines, not your neighbor's hot stock tip. It was about price. Pure raw price. Let's break it down into the mechanical detail that made it so powerful. The turtles used 2 breakout systems. A system 1, buy when price breaks above the highest high of the last 20 days. Sell or short, when price breaks below the lowest low of the last 20 days. A system 2, a longer-term variation using 55-day breakouts. Why use 2 systems? Because markets aren't always trending the same way. The shorter breakout captured quicker trends. The longer one kept them in the big moves. These rules had no room for interpretation. The price either broke out or it didn't. This binary approach removed emotional debate and second-guessing. Once in a trade, the turtles didn't try to call the top or bottom. They used trailing stops to capture the heart of the trend. The exit rule was straightforward. 4 longs. Exit when price breaks below the lowest low of the last 10 days. 4 shorts. Exit when price breaks above the highest high of the last 10 days. This meant they stayed in winning trades as long as the trend continued, even if it meant enduring pullbacks and volatility. It's simple in theory. In practice, It takes serious courage to watch a big profit shrink during a retracement and still hold firm. The hidden edge. If you ask most traders about their edge, they'll mention entries, exits, or indicators. But the turtles knew the real magic was in position sizing. Dennis taught them to size each position based on volatility, using something called the N value, an average true range calculation. This ensured that risk per trade was consistent, regardless of how volatile or quiet the market was. Their rule: risk no more than 1 to 2% of capital per trade. This meant no single loss could devastate them. It also allowed them to survive the inevitable strings of losing trades that come with trend following. In a world where most traders blow up by betting too big on a sure thing, the turtles played the long game. The non-negotiable stop-loss. A hallmark of the turtle blueprint was the stop-loss discipline. Every trade came with a predefined stop based on volatility. No ifs, no buts. When price hit the stop, they were out. There was no moving stops lower, no adding to losers, no bargaining with the market. This single practice saved them countless times. Because in trading, survival is everything. You can't profit tomorrow if you blow up today. The real battlefield. Dennis once famously said, "I always say you could publish my rules in the newspaper and no one would follow them. The key is consistency and discipline." And he was right. Many traders chase the latest indicator, the fanciest software, or the secret edge. But few realize that trading is 80% mindset, 20% system. The turtles faced psychological challenges daily. Watching a winner pull back before moving higher. Enduring 10 or more consecutive losing trades. Sitting on the sidelines for weeks waiting for a signal. The emotional temptation to intervene, to override the system, was immense. But Dennis's core lesson was this: trust the system over your emotions. Every single time. This is where most traders fail. They know what to do, but they simply can't execute when real money is on the line. Pyramiding. Most traders get nervous as a trade goes in their favor. They start taking profits too early, afraid of losing what they've earned. The turtles did the opposite. As prices moved favorably, they added positions using a pyramiding strategy, while still controlling total risk. They didn't let early fear clip their upside. By adding to winners, they amplified the impact of big trends that could pay for many small losses. It's a powerful, underused tactic that requires immense mental strength. The edge you can't measure. The turtles didn't chase setups every day. Some weeks they sat in cash doing nothing. While others around them scrambled, glued to the news, the turtles waited. They understood that inactivity is sometimes the best strategy. Patience is a weapon most traders lack. Because most don't want to feel left out or lazy. But the turtles knew that forcing trades is a fast path to ruin. Proof in the millions. By the end of the experiment, most of the turtles were millionaires. Some went on to run hedge funds, manage institutional money, or teach others. The strategy wasn't just theoretical, it was battle-tested. The final tally? Over $100 million in combined profits in just a few years. Curtis Faith, the youngest turtle, turned his $2 million allocation into more than $30 million before age 25. These weren't people born with a trading gift. They were normal people who committed to a set of rules and executed them relentlessly. The blueprint, distilled. Let's break it down one more time. 1. Follow the trend. Only trade in the direction of a confirmed breakout. No predicting. React only. 2. Use strict entries and exits. Buy 20-day or 55-day breakouts. Exit on 10-day lows for longs or 10-day highs for shorts. 3. Control position size. Use volatility-based sizing in. Risk 1 to 2% of capital per trade. 4. Use hard stops. Predefine stops using volatility. Never move or widen stops. 5. Add to winners. Pyramid positions as they move in your favor. Scale risk carefully. 6. Embrace small losses. Losses are the cost of doing business. And no single trade defines you. 7. Trust the system over emotions. The discipline is the true edge. Sticking to the rules is harder than any chart pattern. Why most fail? Despite the simplicity, most traders fail to follow this system. Why? Because it requires psychological fortitude. most traders can't handle. A 40% drawdown. Watching gains evaporate during pullbacks. Doing nothing for weeks. They crave constant action, emotional highs, and the thrill of being right. The turtle blueprint demands the opposite. A detachment. Boredom tolerance. Long-term thinking. The turtles didn't care about individual trades. They cared about executing their edge over hundreds of trades, knowing that the math would work out. This is why Dennis said the system could be published in the newspaper. Because knowing the rules is easy. Living them is rare. Beyond money. The turtle experiment left a legacy that still echoes today. It showed that trading isn't magic. It isn't reserved for the naturally gifted. It's a skill that can be taught, if the student is willing to accept discomfort, boredom, and emotional challenge. It also changed the way we think about systems trading and risk management. The turtles became a living demonstration that true freedom comes not from trying to control the market, but from mastering yourself. The choice. Most traders will keep looking for the perfect indicator, the next hot stock, the holy grail system. But the truth? The blueprint is already here. It's been here for decades. The question is not, will it work? The question is, will you work it? So ask yourself, do I want to be right or do I want to be profitable? Because once you accept that you don't have to be right all the time, once you trust that small losses are necessary stepping stones, once you finally let go of needing to control the outcome, you don't just trade, you become a turtle. The blueprint is simple. The results are undeniable. But the execution, that's where most fail. Are you ready to stop predicting, stop forcing, and start following? Because if you are, welcome to the turtle tribe.